Yeah.
And we're live. Okay, welcome everyone to Farmers in Finance. I am Rico, and my co host here is Gaurav, straight from
Hello.
India. Hey, Gaurav,
Yes.
how's it going today?
Good brother. How are you? How's the morning in Canada?
Oh, it's getting cold. Gotta love the winters here already.
Oh, yeah, it's getting cold here also, but not that
Yeah,
much. Pretty
not that
decent
cold.
cold.
Yeah, I think this morning was like -4.
No, it's like 15 here.
Yeah.
Yeah.
Anyways, this is Farmers in Finance. We try to teach you and educate the public on ways to free yourself and actually find true freedom and in your finances. It's not just for farmers, even though me and Gaurav are farmers at heart. And yeah, we just got involved with finances because it's a key concept to understand, and of course, nobody teaches you about it. So it's a journey that you have to enter on your own and research and so we always put on a show just to educate and help out people from what we have learned in life and in finance and working with other financial institutions and to get the truth out there because it matters at the end of the day what you say and what you do. And this world needs a lot of help so far because everybody's struggling, especially lately with where we've seen a high lodge job loss so far, and the economy is not looking so good. But if you stay positive and if you keep discipline, that's what we talked about last show. It's all about the discipline and you implement whatever you learn. And even if you get something from this show and you implement it just slightly, you don't have to go full in and start understanding the concepts. And it goes far ways. I mean, it helped out me in my careers and helped out Gaurav. He's got multiple businesses and he's got a degree in business as well. So he has done the work, and so he speaks from experience. So, Gaurav, how do you want to start this show?
So, like, it is one of the most interesting findings I had lately in my life, the infinite banking system, because we don't have, like, I didn't had any knowledge about this. People use it in different ways, like having assets and then borrowing against it. Like all big players do it, but I didn't knew that a common man can also build an infinite banking system for himself. One of my like best topic is like infinite banking, and people sometimes they mix it with being rich. So having an infinite system doesn't mean that you have to be rich. You can make a system up to that level only, like for how much you gonna basically transact with a bank. Just take that number and use it for yourself. That's it. It doesn't have to be like millions or billions. It can goes in start. You can start as low as 500. But yes, it's different than savings, and then their infinite packing system is like a modern way to be in the system but get free out of it. And getting free is not like getting away from the money, but getting away from the rules and regulations which some other party puts upon you when they're making money out of you from your effort. If you change
Yes.
that and you define the rules how you want to do it, that's infinite banking system.
Yes. And that brings us to today's quote from Chet Holmes. He's a guru on the ultimate sales machine. He wrote a bunch of books, but the most famous one is the ultimate sales machine. And the quote goes, implementation, not idea, is the key to real success. This ties to farming, is like you can't grow a crop by thinking about the seeds. You have to plant them, right?
Yeah, exactly.
So it's in this show, we want to see why becoming your own banker is important in how you see finances and how you see your financial future. So, having said that, we're gonna start here. We set up for the first time a little presentation. Why becoming your own banker is essential. Um, oh, like understanding the infinite banking concept, and we're gonna go through some farming analogies. So, in order to grow something, you have to plant it.
Yeah.
It's not going to grow just out of imagination. And then also, when you have a business, you have to, it comes from an idea, obviously, but then you are going to do the research in how to implement the idea, and you have to have a big why in behind it, because the why is what's going to create your motivation to keep doing it. And that's the same thing with the banking system. Is like, why do I need this banking system? Well, obviously, like, I'm gonna say my opinion for why becoming your own banker, and then we'll switch over to Gaurav, and then he's gonna say his own. But everything we do in life has to deal with money, right? So you're gonna one day purchase something or get a loan for a car or buy a house, because that's how the system works. So I say become your own bank, because you're going to use a bank. And if you know that there is a system out there that you can implement the same as the banks are doing, but at a smaller level, why not use it and create a legacy for the future generations and teach them how to implement these systems? Because obviously, as we all know, this these these concepts are not taught. We don't go to school. We don't even have financial teaching is in schools. They're all like uh, they're all about social studies, so that focuses on the past. English, yes, those are essential. Math
Map.
could be implemented and made more fun if you actually worked with actual numbers and everything like that. So I leave it at that. I think becoming your own banker is essential if you want to get and be in this system, and if you want to loan, and if you want to buy things, and you want to build businesses and finance them and all that, and use money. What do you think, Gareth? Why be?
So infinite banking is a way to create multi-generational wealth, even if you are not making like millions or trillions of dollars. When you say wealth, wealth is not about having money, but having a mindset to preserve that money. So, infinite banking is a series of thoughts about saving money, transactions, what you're doing outside, and how much you're saving. By understanding the money and working around like how banks work, you just copy them, but copy for yourself. You're not involving anyone else, and that's one thing. Second thing, if you implement it proper through like proper channels and everything, you can implement it for generations to come. And there's within infinite banking, there's a word called waterfall method, in which you can make money waterfall multiple times every time it passes through the generations. And that's
Yeah,
how one of the biggest families in like North America, who introduced money and these insurance systems, they themselves have been doing that. And biggest example, if someone has to like see like, okay, really, is it there on documents, I can see those numbers, go and check one of the few of the biggest banks P&L statements. And when you go and search about their assets, they have millions of dollars of whole life policies,
yeah, yeah, and
where they park their own money. Like banks use our money, but when it comes to like what they own themselves, one of the things they own is one of like, and it's not like small. It's like I'm talking about like 500 million dollars at that
oh
level,
yeah,
because
oh
in
yeah,
billions.
yeah, yeah, big
So
big
if it
loans.
goes through multi generation, going through a waterfall method, implemented properly, you can actually create a system in which you can create wealth not only through money but through education, through series of actions which you perform with bank, you just perform for yourself. That's it. It's
Yeah.
as that simple. And just to let everyone know that it's like we are talking about processes, the amounts and what you want to transact or want you to bill is highly customizable, and it depends on one's finances. One shoe fit for all is not for infinite banking. It's like highly customizable. You have to actually sit down. We will help you through go through those numbers and everything, and then we implement this system for yourself and for your family.
Yeah, I agree. So to summarize what Gaurav said is about legacy. It's it's something that we're not even taught, how to leave a legacy for our future generations. But as a parent, I want the best for my child, and I want to leave him a legacy. But that comes with responsibilities. So I have to educate my
Exactly.
children as well, and to do so I have to educate people, because it's it I mean, if I teach just my kids, then the whole world will be left alone and they can be isolated as well. But if we teach collectively, then the whole world will benefit, and we can actually focus on creating more wealth for everyone around us, and not just for the few. And this is why we have started this. We just don't want to create wealth just for the few. We want to take back what it's owed to us. And that's everyone should have a legacy.
Exactly.
So moving on to our next story is, okay, so like what we talked about last show is you start your own bank. So, and this is, we went behind the why. So when you start a business, you have to think it as a business in itself. So it has marketing, it has everything. But what most important is, I like the way Nelson Nash puts the concept is, with money you tend to go around if it comes easy. So I want to put the concept of like um, owning a business as in a grocery store. So you have a grocery store, and obviously everybody knows that groceries profit margins are very low, and in order to sell a product, you have to have staff to stack the shelves, you have to have the location, you have to have the marketing, you have to have everything in place. So when the store manager displays a can of peas, it costs him about $1 to have that can of peas, and over top of that he sells the can for $1.10, because obviously you can't sell it for more or double, because then you're higher than everybody else. So you got to keep your competition in order to have clients and customers. And then when you go and have the temptation of being the owner, it's because I own the store. There is the temptation to go out the back door and taking that can of peas and not paying for it. But if you look at it, when you take that can and it costs you $1 to have it in the store, in the display, and everything like that, you need to sell 10 cans to recuperate the cost of you taking it out of the store. So it goes to say, in same analogy to your banking system, if you take loans off of your policy and don't plan to pay them back, the system will fail, because to recuperate the cost, it would cost you 10 times or more to re-establish the business.
Yeah.
And there is a high temptation in that, right? What do you think, Arif? Does this?
It, it implements to even to your TFSA accounts as well. Like if you think Some people use TFS as like, I will take out money and then I will do something. Unless until you're taking out money from TFS and putting in a business that it will repay. But if you're thinking of just taking that can and you're not getting any money out of it, basically you're spending it. So you have to start again to buy that can. It's like you have to replenish your TFSA again. Meanwhile, you lose whatever you're earning, you're putting it back. So it's kind of like you're repaying or replenish your TFSAs or assets. That's the problem with us. Like we take out money from saving, spend it, and then with less money, it's just struggling to grow. And then in the meanwhile, we put in money back. It is already like you missed either a high or you missed the compounding. Without
Yes.
compounding, you're never gonna retire. That's pretty simple. Unless
And
until
then
you make
and
a
then
huge
also
start.
replacing that can becomes more and more difficult, because
Yeah,
if you start off the wrong way, it's like it's going to cause uh, issues in the end. So you have to set up the business properly, and this is why we start with this story, and also does Nelson Nash in his book, Becoming Your Own Banker, because the concept has to be grasped that you can't walk out the back door. You have to treat it like a business, and you
yeah,
are a client to the business. You're
yeah.
not the owner that feels entitled. You are the client.
Just like
So
how you will trade with bank, like have rules,
that's right.
but
So you go
but
to the
make it
bank,
by yourself,
apply.
not by the banks. Make it by yourself and stick to them.
That's right. So that's why we're stipulating and we're reiterating about discipline, because discipline, it's what makes you plant the seeds, nurture them, and as in farming as well, it's like you plant the seed, you water it, but you're not going to harvest it earlier, right? You want it to mature, because that's when it's going to generate the most growth and the most money. So it's the same with your banking system. You have to apply it, which is application and getting into action, feed it, nurture it, so fund it, grow it, and then implement the systems that you've learned, harvesting. And it's the same thing with the banking system. Correct. Um, so simple analogies, yeah, planting it as savings as well. Because the infinite banking system has a saving component. So when you harvest something, like just in farming, you have to save it, and you got to save it for the next crop as well, right? And the same thing goes in milking, right? Correct me if I'm wrong. You save your best stock, right? As they grow, and you see them as babies, and then you sell other stocks to implement, your fundings to buy the
Yeah,
feed and everything. But the
yep,
best, you save it for yourself, right?
yeah,
And over the
yeah,
years, you've created this experience to understand and and uh, and value. And then what another thing, simple analogy to understand is that by harvesting these loans, but you are building your business. So it will be easier to actually manage your infinite banking system, because you would be paying into the policy and actually growing it faster than you can actually fund it. And that's the time that you can actually start multiple policies, right?
exactly.
Right.
Even if you take one and do as it says, like uh, start with like what you have, don't break it rather than loan it. So you keep the investment going on, the compounding, and then once you have taken a loan and you have the money back, put it back so you can take it for next time or for your worst times.
Right. Okay, so we're going to go down to the numbers, and what we put together is a bit of a. I'm going to share the screen. we put together two life policies, one at 35, so that we can actually see the numbers, and then we put one for a 45. John the farmer is our farmer that we're actually doing the policy for, and this one went a
It's a
little
previous
too
one.
big.
Yeah.
Yeah,
Where's previous and now this one?
yeah, I just added on the. Okay, I had the policy here too.
Okay.
Okay, so John the farmer, single life policy, non-smoker, because obviously we know if you're a smoker, the policy gets a little bit bigger. So out there, don't start smoking. It's not good for getting your policies.
You will be
Paid,
paying double the premium.
hey,
You
your
will be
premium
paying
will
double
be
the
double.
premiums.
Yeah,
That's
yeah,
the only drawback.
yeah. So dividend option, paid up insurance, deposit option illustrated is for 30 years. Lifetime deposits option of 360,000. So that adds on. And then we added a little bit of a rider of $1 million for the first few years until the policy builds for 20 years. And this is your monthly premium. Then what we want to show that looking at the premiums, so your guaranteed values are what's guaranteed, like what you are purchasing right now. The non-guaranteed values, it's what grows with the dividend. Am I explaining this right, Gareth? What do you think?
Yeah, yeah. So every year they pay dividends. That's why that's steady growth. So granted value is like if something goes wrong, which haven't happened in past 200 years in Canada, but it's a norm. They have to show it. They will at least pay the guaranteed values. Let's say they are in sixth year. So the new guarantee value will be 14,051, which is the guaranteed value for the fifth year. So it keeps changing like from one to the other one every year the non-guaranteed value becomes the guaranteed values for the next year. So
Yes,
this is just to like illustrate if something goes wrong like something, then at least you have this money.
that's
Otherwise
right.
you get it, and absolutely you get this only for past 200 years. There have been not even a single case in which they have just paid the guaranteed values. They have paid always the non-guaranteed values with the dividends.
Okay, so these are guaranteed values. So that means that if you pay just the minimum, you in your policy, you are paying 25.51, and your cash value grows to $78, and your death benefit is 1.1 million. Now, if you added the extra payments, in this case, we did $1,000 a month. So times 12, that's 12,000 for the year. And then plus the guaranteed annualized premium, that's a total of 14,551. So the first year, your cash value is 11,642. Now, your death benefit increases because you're buying more insurance as you do the paid up addition. So and that death benefit will see the growth. Well, we're seeing it right now. So after 5 years, let's go towards the strategic points. After 5 years, John the farmer is 40 years old. Let's say he continues on making his payments of the full annualized premium. So he invested 14,500 every year. Now his cash value grow to 65,000, 66,000, well, 67,000 approximately. And now his total death benefit is 1,385,000. So that's a pretty good growth. And these charts are made out of the dividend scale that Manulife gives is about 0.5% of the current rate. So they don't give you the true trusted rate. Obviously, the dividends are not guaranteed, but they have been paying dividends since the inceptions, and they haven't skipped. It's not like like an investment where if you were to put it in the SP 500, you gain 10% one year, and then you lose, like, for example, this year we're starting to lose money, and then you go negative. These have been constant dividends paying over time. And that's the beauty. It's like having an asset that grows constantly, and you're assured that growth is going to happen. You're not well guaranteed. That's why they're not called guaranteed, but it's still an assurance that they've been in business. So it's like, you're creating a contract with a company that gives you the most trust, right? Like if you trust the company, and then obviously I'm pretty sure that everyone has heard about Manulife. There's other companies that we can create these illustrations from, but Manulife is one of the best out there so far.
And oldest. It's been there from 18th century, so it's quite old.
Yeah, it's quite old. It's been around for a long time.
200 years.
Another point to see in the policy is year 10, because now our farmer John is 45 years old, and he has paid in 10 years 145,500, and he's grown his cash value through dividend paying to 162,000. Meaning, if you take a loan out at, I'm just going to see the calculator. Oh, the calculator comes here. If you take a loan out at 90%, usually the companies give you 90% loan to cash value. And if you took and if you put in the policy 162,000, and then times that by 90%, you are able to fully take out all the money that you put in and invest it into the system. This is called the what's this point called? It's like the implementation point. It's where you can actually loan. But the beauty of this system is that if you loan this money, your cash value still grows. It's getting paid. And that's why we love this system. The money, it's in the cash value. It wasn't removed. You just took a policy loan on that money. And the beauty is, too, that you didn't have to apply for it. You didn't have to have the credit for it. You can get it straight into your bank account in like 3 to 4 or 5 days. Right, Gaurav?
You said it right. Absolutely. The main thing is, let's say, if somebody had even like, if they are putting enough money in TFSA, but there is a limit to TFSA as well. But if you touch TFSA, let's say you want to get something of 145, the same amount. You take that money from TFS, you still have some money left, but not that. Okay. Because in 10 years, it will not grow to like millions. It will be like pretty much par, maybe like 210 or 250. You take that out, you spend it, you will be left with compounding or maybe like $50,000, and then you have to replenish it again to compound to get the most benefit of compounding. But in
Right.
here, like you said, when you take out the money, you still left with the whole pool, like whole asset value, which keeps appreciating itself, like the snowball method. Every year you have more and more, not only the premiums which are you adding, but also the compounded interest which is adding to the value.
Yeah, and then I just want to show the illustration, because that inflection point is one of the critical points in the banking system. But then, as we look at age 65, Farmer John has now paid 30 payments, and has grown his cash value to almost $1 million, and his death benefit is now to his heir is almost $2 million. And if we go on, the cash values keeps increasing and compounds over time. And then after 65, you're only putting in your total annual premium. You stop putting in at 65 because that's the retirement age. So you're not going to be able to fund uh, strategically. I mean, you can increase the value as we can play the numbers. But for Farmer John, we said, okay, you're going to retire at 65. You won't be able to grow your cash value inside your system. But with the premium payments, that's just offers you the coverage is still growing. The cash value at the end of 90 years, that's when we made the policy to pay to, you're now growing your cash value to 3,211,000. That's not, and it doesn't matter what you do with it, that's still your cash value. I mean, you can loan out of that cash value 90% of it. So you could have taken, we can do that calculation quickly. 971 times 90%. You could have loaned out to yourself almost $3 million over the course of this policy. And now your death benefit is still, even if you had loaned out $3 million, you would still leave to your heirs $1.2 million. I mean, talk about legacy, right? And talk about how you can implement this in farm, the equipments, the tractors that you would have bought, right? And this would create sort of a financial freedom for so little knowledge, and just a quick implementation, just to take action today. It would benefit you as well as your family and heirs to be, grandchildren, and so on, right? So
Yep.
just to Gaurav touched on this a little bit, and the difference between whoops, I can't see you guys. The difference between investing and actually using this system. And Gaurav was mentioning that at the time, like say we are at 10 years in and we want to finance our tractor for the farm, and say the tractor costs us $50,000, right? So if we invested the money into a system at 6% returns, obviously to be an investor at 6% return, you have to be good. You have to learn the system, because you have to know when to take out your investments, when to re-enter the market, and that takes a lot of experience. It's not easy to do, right? Like we're in finances and we have the tools, and we still are, it's still a hard time, because you have to monitor your account, like on a daily basis. You have to watch the stock market, and then even in real estate is still. But even if you invest in real estate, which some people do, you still have to watch the market. You still have to put in your money in time into getting proper tenants. You have to do background check. You have to get your rent in and
Manage it, like, get it repaired.
Right?
Yep.
Yeah, and that takes time. So in comparison, having your banking system and managing any type of asset, I believe it's the same. I don't think it's going to take any more understanding once you do a couple of policies, and once we can show you a couple of illustrations. I think you can grasp the concept. I mean, it's hard to grasp it as first as you see it, because there's a lot to it. There's a few components, but as you educate yourself as well, and trying to research it, the way you need to understand something, it will come naturally to you. So I think for your time, they're both equal. Okay. So if you have managed to learn how to invest the money at a 6% growth, and then you are investing just at the same time into an insurance policy, let's say that the insurance premium to cover the death benefits are are about $3,000 a year more, so that you can invest that money into into your investment accounts. Okay, so having said that, your money will grow. And what I wanted to say is, where do I find that slide? Oh, never mind. I wanted to show, we had a slide that it showed that if you invested the money at 6% in 10 years, you would have $191,000, compared to your life policy that we showed earlier. That was, it was $162,000.
Yeah, it is there.
Yeah. So 162,000. Now we take out a policy loan of $50,000. Now our $191,000 loan gets down to $141,000. When you're taking out your policy loans, that funds don't get touched, right? So after that, what comes to mind is like, how much are we going to accumulate over the principal if we don't touch it, right? And if you have the $162,000 and they keep growing, obviously we're not putting any more deposits. This is just to create the illustration in people's minds. For the next, let's say, another 110 years, and then we keep the same growing rate. Right now, they're offering dividend rates at 6%. So our investments and the policy are growing at the same rate. We would have a maturity of $294,000 after 10
Compounding
years.
is annual here, not the monthly. If you do
Oh,
the
yeah.
annual one,
Sorry. Thank you. So $290,000 compounded annually. Okay. So now we'll do an illustration on the $141,000, because you took your tractor money out. And we're not going to do any deposits or anything like that. This is just for illustration purposes, because then obviously as we shown before, we're going to grow the policy because you're still paying the premiums and you're still investing. But this is just to show what would happen to the funds when you take it out. And then we'll do this annually as well. And you have $252,000 at maturity. So this goes to show what happens. Oh, love the advertisements. $290,000 compared to $252,000. That's a $48,000 difference. Ha! What
you
are
get your tractor back.
Right? You paid your
Yeah.
tractor back.
And there are three things additionally. If we compare both, let's say you don't use your cash, but you say I want to take a loan. The in India, the farm equipment loans, and I assume it is in Canada as well. The loans are more expensive than these loans, so you pay more interest as well. Secondly, you have to get approved through certain things. If let's say it's a bad month, you don't have income that year, or you fell ill or something like that, and they are saying that you will not be able to pay your loan. They'll not pay you a loan at that time. So we are talking about not
Yes.
only like business expense, but as a personal thing also. If when you need money, what you can do with it, One is that. Second one, the taxes. So if you're maxed out ATFS and let's say you're putting this money in somewhere else in like regular cash account and investing in stock market, you will have to pay your capital gain tax before it is transferred to your next generation, which makes things even more messier. Like you will, even if you save money, you will not be able to transfer it over like as a whole amount. So you don't have to basically with infinite banking system, you leave 10 times more than what you were saving at that time.
Right.
If you
Yeah.
compare, it
And
is
that,
weird because the death benefit is already like against, like first year you paid $14,000. If something happens in first year, you already have 1,112,000 dollars. So for
well,
every dollar, I just paid like maybe 10 cents.
yes. What about,
If you save the money, you will have only how much? $14,000. You may get a term insurance, like we also added a term insurance, that's for sure. Okay.
yeah.
But in that case, if you live longer and you do your term expires and your all your money is in your other than TFSA accounts, you're gonna pay a lot of taxes on that. Even if it's TFSA, let's say if it's a TFSA, either way you will lose compounding. Either you pay in taxes or either you lose compounding. Either way you have loss of one. With infinite banking system, both of these things work for your own banking system and your own growth. You don't pay taxes, you don't have to be at mercy of the banks to get approved for a loan, and you can get it however old you are. Whatever you want to do, you want to buy a farm equipment or you want to buy a house for your son as a wedding gift, or maybe buy another piece of land like a big one if you want to invest a lot of money. Rich farmers can actually do a lot more and more with such kind of policies.
And then what about, if you miss a payment? Because life happens, right? You, like you said, you get sick. Okay, you got the loan from the bank, you miss a payment, they're going to be on you, right? They're going to be
No,
calling you. They're going to be taking,
they
and you
don't
miss
worry
a
about
couple of,
it. Yes, in loan,
and
yeah, like you said, they will not be after you because it's your own banking system. Even if you
that's
don't
right.
pay, you don't have to worry about anything.
That's right.
And people need money in most of their dark times, and like banks are like opportunist. They'll give you a loan when everything is good, like you have money or you have everything. But once, let's say, you consume that money and you need more loan for your thing to do get done, and they ask you, do you have money? You said no. And do you have anything to generate money? They'll say no. They will refuse you a loan.
Right.
And
And so
so
if you miss a couple of payments, they'll come and take your freaking tractor away. And then
exactly,
that is your business generating income. While
exactly.
with your own banking system, you have security, not just tax protection, not just application and and procedures, right? You have a solid system that prevents any of the problematic happenings that happen in life. You know, life is not perfect. You know, you might get sick, like Gaurav said, right? You don't want to lose the tools, or you don't want to lose your car. You don't want to lose your house in that sense. You know, like if you build policies big enough, you can actually do your own mortgage, or you can start off small and partially do your mortgage. And then as you increase your payments, as your banking system grows, you can slowly take over that mortgage and grow your business as well, your banking system. So it's like it's a it's a huge wealth transfer. This concept is, this is why the why. And like Gaurav said, you are going to use in life, and we said it at the beginning too, in life you're going to use loans, you're going to have to use a banking system, right?
like For farmers, even they need more, like they need working capital, they need for basically buying pumps, they need to build sheds, they need to buy farm equipments like tractors, shellers, like they bunch of stuff they need to transact. A common man, they just transact for house and what do you say, a car, maybe education, that's it. But for farmers, they need it at every point, every
Every
point.
point, every point is so, it's such an essential system, and that's why I implemented it, because it's like you said, like now I can buy my own tractor, because on the first, like what we saw in the policy, you accumulated a cash value in the first year of $11,000. I started right away. I was like, I needed a tractor for five, so I borrowed five, and then I bought the tractor. And guess what leverage I had too? That people don't think about it is I paid cash. It
So
wasn't a
you
loan.
so you
So I
actually save some
leveraged.
money on cash deposit as well.
Right,
They
right.
give you a discount, basically.
Because it's like when you go to the dealer, there's different treatment if you're financing or if you're paying cash, right?
Yeah.
Because their profit margin is higher when you pay cash because it's an immediate transfer. But a loan is a projected uh, value. So they're more weary, and that's why they put the high interest rates too.
Yeah,
Like,
that's it.
and on your
Farming is
repayment.
farming is one of the most risky business as classified.
Yeah.
I was a banker myself. I used to loan tractors and everything, so it was one of the most risky. So high interest rates. Second thing, you don't pay for your file charges or like any charges involved. Like hidden charges are there. Like you pay for file charges, then you pay GST on that. Okay, and then they keep a commission for themselves for getting that loan approved. It's not like the company gives it for free, it is paid out of your pocket. It's pretty much the same. And then if you compare a asset like whole life policy, loan interest rates is, let's say it's 6%. On the other hand, the interest rate for the tractor, if you go and get a tractor, it might be around 10 to 12%. So by
Yeah.
this way, you save a lot of money, not only on the compounding, but also on the interest rates.
uh, and then that's where you start making money. You start
Money.
saving on the interest rate, but then you obviously you have to pay your repayment back. What Nelson Nash says, do the
No back
same
loan.
as a bank would do it,
Yeah.
right?
So pretty
Because yeah, sorry.
So it's like pretty much whatever you were paying outside, like interest or like the money you were supposed to earn, which banks are earning because when you give them that money, is loaning to different people and making money out of yourself. For this time, you save money on interest paid and earned. Also, the thing you were saying, like if you implement the system like bank only, let's say you have to be strict on, like let's say I took the same loan from the bank, would they allow me to not pay it? Just think like that. If things get worse, that's one scenario, but you have to be strict, like Nelson Nash have said, make it a system like how you treat a bank. It's not you, treat it like, let's say John is here, so John is not the bank, it's John's bank. You can
John's
name it
bank.
like John's
Yes.
Bank,
Yeah.
like my bank. I will name it. But these are two separate entities. Like we have in past, we have asked people to keep them separate from their business. Like you are personal, your business is a separate entity. Treat them like that. Same goes for your whole life policy and your banking system. They are separate from you. If you treat them as your bank, have some relationships, like have a contract with yourself, with your bank. Like
Yeah.
I will be strict on these things because you are helping me to make more money, and you will
Yeah.
make, like it's simple. Let's say you took a loan from bank and you never paid back. Next time if you're getting things, it will be hard for you to get a bank get a loan because of CIBIL. Same goes for this one. If you are using it today, after 5 years maybe you need another tractor. If you haven't paid it back, maybe they will approve for you a small amount, or maybe you want to do something big, like acquire a different farm. or acquire a different line of
Yeah,
chain like
exactly.
truck, or
Scale.
maybe the
Yeah,
packaging, maybe a packaging unit, or you want to buy a big farm adjacent to you. So you will not be able to do it, even with banks. So if you keep the relationship same as what you're keeping with bank, define the rules, have that contract with your bank, John's bank with John contract, you do it, you will never fail, and you will make money on every transaction you're gonna do with them, and
yeah,
every day, because compounding happens every day, and you pay interest every day. It's like monthly, but it's calculated on a daily basis.
yeah. And I mean, that's what I used it for too. Like my car insurance when it was small, I instead of like going through the ICBC where they charge you, 6% interest on the loan, I would
Yeah,
just pay straight cash. I wouldn't get extra fees or nothing like that, and it would just I would recuperate even if it was small, like $1,000 a year. But all that helps you build your system because now you're reinvesting the interest that you were going to pay to the bank back into your system, and your
yeah,
policy keeps on growing. The cash
keeps
value
on
keeps
growing.
on growing.
You
And
keep it
obviously
paid
that
back.
and that's
The
why it's
saved
important.
$1,000. The main thing is, let's say you save that money through your like your whole life policy. You pay it back to the whole life policy, plus you pay extra ₹1,000, $1,000 which you saved out of that interest.
Yeah.
See how it goes. See how it
Yeah.
explodes, like your death well benefit and your cash value, both of
Yeah.
them.
Yeah. And that's the other thing too. If you were to apply for a mortgage, because obviously your cash value is not as big, all these policy loans, they don't affect your credit score.
Exactly.
They're out of the system because it's like it's like your own bank, but
Yeah.
they are not connected to the other banking system. You're
Exactly.
separated. And
Exactly.
these are all like there's so much to know, but I mean, these are all amazing features that come as you learn this system, right? And
Yeah.
as you implement it. And like today was why becoming your own banker, but it's more like implementation is it goes far beyond just the idea. So we're proposing the idea, but it needs to be implemented, and you need to try it. And if you want to try small, because like you can always buy policies and start different branches. Nelson Nash calls them branches. Each policy is your branch. So once like Gaurav said, for example, if you have grown your cash value and now you're able to buy the next door neighbor's land because you have $500,000. I don't know how much land is over there, but let's say it costs $500,000, and that's your 90% cash value policy loan that you can get. Guess what? You can start another policy,
Yeah.
and then you can start policy on your children. Uh,
Multiple assets
yeah,
and
we at
multiple.
Experior we call them, the $1 million babies. As soon as a baby is born, 15 days later, you can put in a policy, and it can be small, but by the time he's 20, guess what? He's able to finance his own business, or he's able to finance his car, or he's able
Education,
education,
or
like
maybe
better than
skill.
an RESP,
Yeah.
right? Like he's able to have a banking system that you can teach him through your life lessons, because each banking system is different. Each farm is different. Like, I had a seed farm, Gaurav
Hmm.
has a milk farm,
Hmm.
and it's different sort of mentality and products and tools that we need to generate the income, right? Like I was a lot about packaging and equipment and tractors and land and greenhouses. Garv is about stock and milking machines and
Yeah.
and staff,
Acquisition
right?
of a machine, or maybe a, like we need a delivery van every 3 years, because when it runs a lot, it makes losses. So we have
Yeah,
to get it every 3 years. So I have, if I say, I have over 8 loans from bank with my business, not me, with my business. I don't have a, personally, I don't have any loan on myself. That's the best thing I've done. And I'm using business is like my internet banking system.
Yeah.
But now they have similar policies in India as well. Next time, I think what should we do? Basically, we will highlight different use cases for industry specific, like how you can use it for a home or how you can use it for a farm equipment, and we'll show the exact amount of the taxes and the interest you save in long run, and how to use it as a waterfall method for your next generations to come.
Beautiful. Yes. That puts us at the end of the show. I hope you grasped a little bit of the concept. I mean, I don't know if
It takes time. It's not
it
easy.
takes time. Yeah, exactly. And
It
then,
took me 2 years, to go in deep and deep and deep, then to understand this, like how to basically what is infinite banking system.
well, and then for myself, as my experience, like I said before, I had to put it in motion. I heard the concept, and I read the book, "Becoming Your Own Bank" by Nelson Nash. It's a very insightful book. It's a short read. I think it's like not even 100 pages, and it's got a lot of graphs and numbers so that you can actually physically see how the policies work. Obviously, each policy, each contract that you have with the different insurance companies can be different, and it can be tailored to your needs,
Yeah.
because it depends what type of like what we said about farming. Like I might not put as much capital as Gaurav does, because in the stock and milking industry, you might need a little bit more money for equipment and all sorts of things. While my policy didn't have to grow as fast, because I think my biggest expense was the greenhouse, which was about $15,000, right? So I am not in need of such a high level, but it also goes with the vision you have about the business. If you want to grow it and scale it, then you got to see it over the future, right? It's just like
Yeah.
planting trees. They're not going to produce right now, but you have a vision. I want this many cherries when they come to maturity, and because
Yeah.
I have this much market out there and all that stuff. So things grows, and like Nelson Nash says, an airplane becomes more efficient the further it goes,
Further
because
it goes.
the farther it goes, it more efficient it becomes.
Same for us when we got into business. Like we had 15 calves to start. It took 4 years to actually get like what we wanted from the business. Like the compound, it happened. It takes time, but if you have like in few cases, if you have a lot of money, you're sitting on a lot of cash, you are a good farmer, and you're actually making money, but you have kept it there. You can actually launch from very next year. Run with wait at all.
Yeah.
So that's a second beauty, and we'll talk about this in our next episode.
Next
We'll
show.
compare
Yeah.
some numbers. We'll talk about John and John, elder brother, who is a more successful and bigger farmer, and we'll compare both how it works for both the clients in different ways and different use cases. So
Yes.
thank you, Rico, for this amazing call. Okay, and
Yeah.
let's
I
take it
hope
down.
everyone picked up a few things here and there. And then, like what we said before, we're here to empower, to educate, and most important is to help people taking control of their finances.
Yeah.
And I hope this was useful for everyone. Sorry we couldn't get to the questions today, but definitely we'll allot some time next week with our case
Yeah.
studies, because then you can more understand the different scenarios and everything like that. And this show doesn't just apply to farmers. I mean,
Yeah.
obviously, we have our heart is into farming, but it can apply to any businesses, and
Any
I am
business.
applying it to real estate
And even
myself.
for self-employed people like doctors, maybe any dentist out there, realtors,
Yeah.
mortgage broker, they can use this concept very well for themselves.
Yeah.
Okay, then.
So on that note, thank you so much
Thank
for
you so much.
joining us today, and hope to see you next week, same time, same place, live from India and Canada.
See you.
Thank you so
Bye.
much.
Thank you.
Have a
Good
good
night. Good
week.
morning. Bye.
Bye bye.